Chrysler approaches the middle of the decade in a condition that can best be described as institutional exhaustion. A defining pillar of the American automotive industry, Chrysler has been reduced to a narrow product footprint, declining relevance, and mounting financial dependency. This is not a sudden collapse driven by a single mistake. It is the cumulative result of decades of underinvestment, strategic drift, and repeated ownership changes that hollowed out the brand long before current market pressures arrived. The most immediate and visible problem is scale. Chrysler today operates with a fraction of the volume it once commanded. Its lineup has shrunk dramatically, leaving the brand almost entirely dependent on a small number of models. Limited scale is fatal in a capital-intensive industry. Fixed costs related to engineering, compliance, and distribution do not fall in proportion to volume. As sales decline, per-vehicle costs rise, eroding margins and accelerating losses. Debt pressure compounds this vulnerability. Chrysler no longer carries its own independent balance sheet, and its operations contribute directly to group-level leverage and cash strain. Investment decisions affecting Chrysler must compete internally for capital against other brands with clearer growth prospects. When a brand fails to demonstrate credible returns, it becomes a candidate for neglect rather than renewal. That neglect is itself a form of slow collapse. Stagnation has been a defining weakness. Chrysler once built its identity on accessible innovation and distinctive design. Over time, that identity faded as product cycles lengthened and updates became incremental rather than transformative. Vehicles that fail to keep pace with technology, efficiency, and interior expectations require incentives to move inventory. Incentives protect volume in the short term, but they destroy pricing power. Over years, this dynamic trains consumers to wait for discounts, further undermining profitability. Electric transition risk looms large. The industry is shifting rapidly toward electrification and software-driven architectures. Competing in this environment requires massive upfront investment in platforms, batteries, and digital systems. Chrysler's current scale makes it difficult to justify such investment independently. Relying on shared technology reduces cost, but also limits differentiation. Without a clear reason for buyers to choose Chrysler over internal or external alternatives, the brand risks becoming redundant. Dealer network erosion is another structural issue. As product variety shrinks and showroom traffic declines, dealer profitability suffers. Some retailers reduce investment, others exit quietly. A thinner dealer network reduces convenience for customers and weakens after-sales support. This directly affects brand perception. Once consumers associate a brand with inconvenience or uncertainty, regaining trust becomes extremely difficult. Residual values provide a harsh but honest signal. Chrysler vehicles tend to depreciate faster than peers, reflecting market skepticism about long-term support and desirability. Weak residuals increase lease costs and financing subsidies. These subsidies represent real cash outflows that accumulate over time. While consumers may benefit from attractive pricing, the manufacturer absorbs the loss, further straining financial resources. Operational morale also deteriorates under these conditions. Engineering teams working on limited or delayed programs struggle to maintain momentum. Suppliers facing uncertain volume commitments demand higher prices or prioritize stronger customers. These pressures increase costs and execution risk. None of this appears suddenly, but it steadily degrades the ability to deliver competitive products. Strategic clarity is lacking. Chrysler's positioning has shifted repeatedly without establishing a durable identity. Is it a family-focused brand, a technology showcase, or a value-oriented nameplate? Without a consistent answer, marketing messages fail to resonate and consumers look elsewhere. Strong brands stand for something specific and deliver it reliably. Chrysler's current message is fragmented. The broader corporate environment does not favor patience. Capital markets increasingly demand accountability and return on investment. Brands that consume resources without demonstrating a path to profitability face escalating scrutiny. Chrysler's survival depends not on nostalgia, but on its ability to justify continued capital allocation. That justification remains weak. The risk is not a dramatic bankruptcy announcement. The more likely outcome is gradual marginalization. Fewer products, fewer markets, less investment. Over time, the brand becomes a shadow of its former self, maintained just enough to extract residual value, but not enough to thrive. Please subscribe to our channel. We want to hit 1,000 subscribers this week. For consumers, Chrysler's current condition introduces risks that extend beyond design preference or purchase price. Buying a vehicle is a long-term commitment, and it depends on the manufacturer's ability to provide consistent support throughout ownership. When a brand operates under prolonged financial and strategic stress, that support becomes less certain. Warranty coverage remains valid, but experience matters. Brands under cost pressure often tighten internal controls over time. Approval process is slow. Goodwill repairs become less frequent. Disputes become more common. These changes are subtle and gradual, but they directly affect ownership satisfaction. Parts availability is another concern. As volumes decline and model ranges narrow, economies of scale weaken. Unique components may be produced in smaller batches, increasing wait times and cost. For owners in secondary markets, this can mean extended downtime during repairs. That inconvenience carries real financial and emotional cost. Software and electronic support are increasingly important. Modern vehicles rely on updates to maintain safety systems and user interfaces. A brand focused on cost containment may deprioritize updates for existing models. Over time, vehicles can feel outdated relative to competitors, reducing resale value and ownership appeal. Depreciation risk is significant. Market perception influences resale values as much as engineering quality. If consumers view Chrysler as a declining or uncertain brand, used prices will reflect that doubt. Higher depreciation raises the total cost of ownership, regardless of initial incentives. Dealer network stability affects daily ownership. Fewer dealers mean longer travel distances and longer wait times. Service quality can vary as remaining dealers operate under pressure. The convenience once associated with mainstream brands erodes, and that undermines the value proposition. There is also strategic uncertainty. If product lines are discontinued or the company exits markets, owners may find themselves with orphaned vehicles. Even when formal support continues, ecosystem vitality declines. Accessories, updates, and community engagement fade. None of this means Chrysler vehicles are unusable or unsafe. Many vehicles continue to serve their owners well. The core issue is confidence. Ownership depends on trust that the brand will remain committed for the full life of the vehicle. When that trust weakens, caution becomes a rational response. From a forensic financial perspective, Chrysler represents a brand surviving on inertia rather than momentum. Its challenges are structural, not cyclical. Consumers considering Chrysler should weigh short-term pricing benefits against long-term uncertainty. In an industry defined by rapid change and heavy capital demands, choosing a brand under sustained pressure carries consequences that extend far beyond the showroom. Please subscribe to our channel. We want to hit 1,000 subscribers this week.